Welcome to PM Express Business Edition. It has come with its shocks for several sectors of the economy. I'm talking about the Domestic Debt Exchange Program. But for the capital market space, there are some that are worried that the shocks could linger on. How do we restore confidence in this space when it comes to capital market operations in our quest to bring back what some would say the first love? We're talking about restoring market confidence post-domestic debt exchange program on PM Express Business Edition. Indeed, I'm glad to have the Director General of the Securities and Exchange Commission, Reverend Daniel Ogbamitete. Reverend, thank you so much for your time, and I really appreciate it.
My pleasure.
It's been quite tough getting you to sit down to talk to you.
I know it's been a busy time, so I'm sure you can understand, why it's been a bit difficult, to make this. But thank God we are here today.
How easy, how challenging has it been for the capital market regulator compared to 5 years ago or even 4 years ago, where you were concentrating on whipping up confidence, licensing companies, scrutinizing listings and all the rest? Now it appears that there's one major area that has taken much of your attention, Reverend.
Well, I think that actually since I came to the SEC, it's been quite a hectic schedule, dealing with the one challenge after the other. As you alluded to, we had to first address the issue of cleaning up the asset management space, and in the course of, as you all rightly said, rebuilding, if you like, investor confidence. We also had to deal with this issue of the domestic debt exchange program, which of course had some implication on the activities within the security space. So I think it's been very busy, and by the grace of God, we are doing our best within the circumstances to ensure that at the end of the day, we have a securities industry that is solid and robust and would play its critical role in terms of mobilization of patient capital needed for economic growth. So we are taking the challenges in our stride and making use of all the resources available to ensure that we are protecting both investors and the integrity of the market.
At the personal level, how have you taken some of these challenges that has bedeviled the industry and even the institution that you're heading?
Well, I know I have come under a lot of criticism,
each and every day,
insult here and there. But for me, my focus has always been whether I'm doing the right thing. And in any situation, I ask myself, what needs to be done to bring a solution? My personal bias is always to think solutions. So while people may be busy, if you like, criticizing, raising issues, I take criticisms in good faith. I listen and take whatever lessons need to be taken. But my focus has been, how do I resolve the situation? What can I bring to bear? What value, what contribution can I make? So for me, that has been my preoccupation, and I can say that I haven't been that flustered by all the criticisms and insults and very unpleasant remarks out there. I just keep focused on what I'm here to do.
Do you think that the expectation might be just too much coming in as a market player? And that is sometimes when I engage some people, they feel that Reverend being an astute market player. And I know when you were there as a market player, there were a lot of things we were pushing to get the regulator done. Now, Reverend is in the position of a market regulator, so we can't forgive him if he gets it wrong.
No, I don't think it's quite like that. Actually, my coming here, I believe, has been very good because my understanding of the other side makes it easier, if you like, to bring the regulated and then the regulator together to ensure that we are addressing solutions. Because really, for me, I see capital market development as a partnership. The regulator should not only be seen as, if you like, a headmaster with a stick, but to have engagement with the market operators, the regulator, to basically ensure that we are working together. And I can say that, and I want to believe that if you talk with the market appraisers, they would say that the level of if like partnership or engagement has been very, very good. I think that sometimes the satisfaction may come from, if you like, misinformation or lack of understanding of what the regulator should be doing. And I can say that crossing over from the other side to the where I am currently as a regulator, of course, it gives me a better perspective. And whereas as a market operator, you see things from a limited viewpoint, sitting on this other side of the table, you get a better picture. But I think sometimes people have expectations which may be unrealistic. It's not, for instance, you're expecting the regulator to do some things that the regulator doesn't have the power, because I must always look at my enabling act and see what powers I have. So somebody is talking about investor protection and expecting the regulator to do something, but I don't have the power to do that. So I believe the onus is on the regulator to continue to engage, to educate, to get people to, as it were, appreciate what we do, why we do what we do, and what the responsibility of both the market operators and investors alike must be to ensure that we get the best out of the capital market.
You talked about education and where you think that has been a challenge there. Do you think that SEC can be doing more, should have done more when it comes to the education area to address some of these challenges? Because some of the issues that even come to me personally, I ask myself, why is the market regulator not that aggressive on the market to try and deal with some of these things? It's a continuum. Maybe you've done it in the past, but so you have to do more.
So George, my view has always been that the room of improvement is never full. So if you ask me, yes, we can do better. We can improve on what we are doing with regard to education, investor education for that matter. But I can tell you that we've done quite a bit. For instance, we introduced time with the SEC, and which we have taken to at least 2 regions, which wasn't the case before. And you know, the last one, which, if you permit me outside, we went to Tamale, and we're expecting, I believe, about 600 people, and we had about 1,200 people. And that sent a clear message to us that there are people out there who really are looking for information. But I'm saying that we have introduced that and we intend to sustain it. We have also stepped up our, if you like, activity in social media, throwing investment tips and some information. So we are doing something in the area of education. I can also tell you that under the Capital Market Master Plan, one of the working groups, that's working group 2, where it draws from market operators and other stakeholders, we are working together to deepen and sustain investor education beyond what the SEC has been doing in the past. For instance, in the Capital Market Week, where we do a number of activities, but we're looking at how do we sustain it all year round and make it even go as far down the educational cycle as possible. So there's a lot going on. But George, again, education calls for money, because it will cost. For instance, if we need to get some of our collateral translated into local languages, if we want to use media that, let's say, people in the remote areas or would be more comfortable with, you need to put out some money. The regulator is constrained by finances as well. So we're doing something, and to answer your question, yes, we can do more, but definitely there has been some improvement in our engagement where investor education is concerned.
I mean, before we come to the market cap issues and even the domestic debt exchange program, and Reverend, I tell you that if I had advertised this engagement, I would have had lots of questions and pressure on me, people want to come with me and meet you personally about that. Even before the market cap, even before the domestic debt exchange program, the people out there, as of now, they are still struggling to get the investment. What is the problem, Reverend?
I believe you are referring to investors or clients who had their funds with some of the failed asset management companies. So let me explain it, just briefly, what the situation is. Now, we had to use the liquidation pathway when we realized that these 53 fund management firms had failed. Unlike the Bank of Ghana that had to their enabling act enables them to appoint a receiver. We don't have that for asset management firms. So what we had to do was, after revoking the license, to basically engage the official liquidator to go to court and to get the court to grant the liquidation order. Now, when the liquidation order is granted by the court, then the official liquidator assumes both the assets and liabilities of the failed entities. And then when they are able to make some recoveries, they will be the official liquidator will be in a position to make some payouts. Usually it's called paying a dividend to the creditors. Now, because we use that pathway, number one, we had to wait for the official liquidator to go to court to get the liquidation order, and that takes a process. Now, what we did, and this is in the line of protecting investors, was to engage the government and to say that, given the fact that people need their funds, given the fact that the liquidation pathway, you can't guarantee when it will terminate. We made the representation to government through the Ministry of Finance for a bailout to be rolled out, because ordinarily, if you have invested with a fund management company that has failed, then you have to wait for the liquidator to recover some assets and then sell the assets, and then from the proceeds make some payment to you, and you can wait for as long as that process will persist. But we stepped in and engaged the government through the Ministry of Finance. So a bailout scheme was rolled out. Now, the ministry or the government gave two key conditions for the rollout of the bailout. One was that the claims of the investors must be validated, and then two, liquidation orders must be granted. Now, out of the 53 firms that lost their licenses, 3, of course, went through the Administrative Hearings Committee, so their licenses were restored. So we had to deal with 50. Out of the 53 that were not managing any client assets at all. So effectively, there were 47 companies that were managing client assets that the official liquidator was taking them through the liquidation process. As I speak to you, liquidation orders have been granted for 44 out of these 47 firms. So 2 are outstanding. Now, the 2 outstanding includes one of the big players, that's Gold Coast, Black Shield. And I think that is where a bit of the concern is coming from. Now, even for that, George, in 2020, we made a case for the government to roll out a partial bailout of up to 50,000, cognizant of the fact that the liquidation petition, it could take long. So that was rolled out in 2020. And as far as I recollect, about 1.43 billion was paid out to affected clients where the liquidation petition of the companies they invested with hadn't been granted yet. And it included Black Shield customers. And I can tell you that I think, if my number is correct, over 74,000 investors of Black Shield were being covered, and out of the 74, over 61,000 were fully paid because their balances were range from 50,000 and below. So I'm trying to say that something has been done. Why we still have some people feeling the pinch and being, if you like, frustrated and angry that they don't have their money is because the liquidation order in the case of Black Shield is still pending, and it's a condition precedent for the rollout of the full
But Reverend, what would you tell those who would argue that Kwabena Mensah somewhere in maybe Mankesim, based on what you had approved, places funds in these companies or whatever, these are licensed companies. Why should Kwabena Mensah in Mankesim be suffering? Because some are saying that Kwabena didn't go out there to put those funds in a Ponzi scheme. And that is where the challenge is, or some are saying that SEC can double up and put pressure to fast track the process.
I think that's a clear misconception. If you take liquidation pathway, as I've explained, it doesn't lie within the power of the SEC. I mean, it's a process that has to take place in courts. So SEC, we don't control the court. Indeed, we notified the official liquidator, so that the official liquidator is actually the one pursuing the liquidation order, because we don't have that power to do so.
But have you pushed? I mean, someone saying that within your powers, have you done what you can do to ensure that the process is fast track?
We have been doing everything that is within our powers to do to, support the process. But with the liquidation petition, you must also allow the affected companies to be able to make whatever representations in court. So we really can't determine the pace at which the process will travel in court. But like I'm saying, out of 47, we've got, or the court has granted 44. I think that is a big achievement. It just so happens that Black Shield is still outstanding, and it's because they've been contesting the process. Assuming Black Shield, and if you allow me to give you a little background, as soon as the license was revoked, Black Shield triggered the provision under the SEC Act 929 to come to the Administrative Hearings Committee against the revocation of their license. Now with that, you can't begin the liquidation process. You have to wait for that process to be over. Now after that, then they went to court, and they've been challenging, so the reason why the Black Shield case, yes, the liquidation order hasn't been granted is because of the fact that they've been contesting at various courts. And so until you have dismissed those issues, you can't really proceed. Thankfully, I mean, at all the stages, their case was dismissed. So now the liquidation petition is being held, but it will again have to go through the court process. So because the liquidation order has been granted, and because it is a precondition for the rollout of the government bailout, it becomes difficult, to do that. So your gentleman who is out there who says, well, I invested with a licensed market operator, I'll say yes, you did. Did you get the partial bailout? I'll say yes, you did. If you hadn't, if it wasn't a licensed operator, if the SEC hadn't made that arrangement with the government, even that partial bailout, you wouldn't even have received it in the first place. So, the issue of SEC is not doing what we need to do. I think people need to look at what is within our power to do and what the other processes needs to be followed through. And then let me also say that I like to say to people that yes, the regulator would license the market operator, but anytime you engage the market operator to, if you like, invest your funds, you must also ask questions. You must educate yourself on the risks associated with a particular investment. I believe when we start talking
isn't that too much for that person who is placing his trust on that stamp that you're giving to that company? But Reverend, just quick clarity on because some will say that, listen, if Reverend has given his stamp of approval to this institution, I can go and sleep. The onus lies on the regulator with the other agencies to ensure that anytime this company opens for business, it has met all the requirements to be in business.
You know that sometimes you can go to the hospital, if I can use that example, and a doctor can write a prescription, right? The doctor is licensed. One, the doctor can make an error. Or let's say the doctor doesn't make an error, but maybe the one dispensing the medicine, who is licensed, trained, can also make an error. If you are the patient, you should be able to ask questions that this medication has been given to me. If you don't ask questions, then anything will, so if someone makes an error, because there's this fact that no matter how well your plan is, something can go wrong. And I believe, George, you are aware that in recent times in the developed
Silicon Valley issue,
exactly.
First Republic, Credit Suisse.
So that tells you that no matter what the regulator does, firms can fail depending on a number of things.
Some would say that look at how the regulators have also acted in that market as well. Very fast, very sharp to protect depositors. And all the market players.
And we did same. As soon as
say it is debatable in Ghana here.
Well, as soon as we and remember, I said earlier that your enabling act must also tell what you can do. I can tell you that we are in the process to look at overhauling the Act 929 to enhance the powers of the SEC. I remember some years ago when we had some challenge here. I happened to be in the US. I engaged the US SEC, and I appreciated some powers they have. Okay, so we let
you act more assertively in terms of the current development to the market
to enhance our resolution powers as well as other things. But I wanted to just set the record straight that when we took the action to revoke the licenses, immediately we got an agent to secure premises and secure records. Immediately we notified the official liquidator to begin the process. The issue is the fact that unlike the Banking Act, that the Bank of Ghana was able to appoint a receiver, and the receiver immediately takes over the assets and liabilities. We having to use the liquidation path, we have to wait for the court to give the official liquidator the liquidation order before the official liquidator can take over the assets and liabilities. And even in our case, we arranged for the bailout. So if people are saying that the SEC didn't act fast, I think we need to look at it well. And I believe if you are honest enough and you look at it, you will have a rethink of that view. I believe that the SEC did what we did expeditiously, especially to the extent that depended on us. Certain things, when it's not it's outside your control, it becomes difficult in terms of how soon things can work out.
So if I get from you, majority of these persons who had their funds locked up in these companies that were liquidated have been paid. I stand to be corrected. Percentage-wise, if you can help me out with that one.
As I said, 44 liquidation orders have been granted, but clearly the big one is Black Shield, and because it's outstanding, so there are a number of their investors. I don't have the number of their investors.
Not to be number specific, but if you put all the investors in one pool, i.e. the Black Shield one as well, can we say that about 40% of these investors have been paid, about 50% of the investors have been paid, or majority of them have been paid? It's now left with the investors who placed their funds in the Black Shield. Not the specific numbers per se, but in percentage-wise here.
Okay, so let me answer the question this way. The approach that was used for the bailout was to pay the affected clients through the special purpose vehicle, the amalgamated fund. So once you signed on to the fund, then you are giving your claim in the fund. But the fund had two tiers, tier 1 and then the tier 2. Okay, so tier 1 would be the one that you can easily access, and then the tier 2 has some restrictions on access. So that is, so for those who have accepted the government bailout, they have had their accounts created in amalgamated fund, so they have the tier 1 and then the tier 2. I'm aware that there has been some delays in the tier 2. That's why I didn't want to just quickly give you yes, but just to show that the situation, there have been some delays with some of the tier 2 payments, but effectively, if you have accepted the government bailout and you have had your account set up, at least you would have received your tier 1, and then hopefully the tier 2 should be sorted out sooner than later. So the outstanding ones will be essentially Gold Coast. And remember, I said that when we did a partial bailout of up to 50,000, over 61,000 of the Gold Coast clients were fully paid.
Okay.
If my numbers are correct, I think the total for Gold Coast will be around 75, almost approaching 80,000 of the number of claims. So it means that we have maybe a little over 10,000 plus of Gold Coast customers who have received partial bailout, but because they have balances in excess of 50,000, until the liquidation petition is granted, it remains outstanding.
This is PM Express Business Edition as you look at restoring market confidence post domestic debt exchange program. How do you ensure that a person out there was placing his funds in bonds and these securities out there doesn't keep his or her money in the house because of what has happened? This is PM Express Business Edition. We'll be right back after this break. Welcome back to PM Express Business Edition. As we talk about the capital market and how do we restore confidence, because some have said that this is what has turned many economies around the world to what they are today. And can the same be said for Ghana? Thank you, Reverend, and welcome back to PM Express. We're there one day and we realized that there was a directive, I think, issued on your website. Is it the market to market? I always struggle with
mark to market.
Mark to mark. Did you really have to do this? Looking at the post effect on the market and the confidence as well.
So my answer, George, is that we need to understand that whenever you talk about investment and you have a portfolio, there's a way in which you value, or you should value, the portfolio. Now, there are different approaches to valuation of the portfolio. Now, there is the amortization approach, where basically you hold, and this is especially for fixed income instruments, you hold the securities you have bought, you hold to maturity. And then there is the mark-to-market valuation method, which basically says that you value your portfolio based on the prevailing market price. Okay. Now, I'm at pains to explain that mark-to-market is actually not new. And in Ghana, there were funds that were marking to market. Indeed, all the equity funds, the equity mutual funds or the equity unit trust, they mark to market because at the end of trading on the Ghana Stock Exchange, they will take the prevailing market price to value their portfolio. That's essentially what mark to market is. You're using the prevailing market price to value your portfolio, because valuation is key for when people are entering into a particular fund or exiting. There must be a value. Okay, so so equity funds were already marking to market. Some fixed income funds, even before our directive, were also already marking to market. Okay, now some, or maybe the majority of the fixed income mutual funds or collective investment schemes had the strategy, the valuation strategy of holding to maturity, or the amortization approach. So because they hold the securities to maturity, they were not marking to market. But take note that there were some fixed income portfolios that were marking to market, because before we did our directive, we did a survey to get a view of the valuation approaches of the different collective investment schemes that we have licensed at the SEC. So we knew that there were some fixed income collective investment schemes that were already marking to market. As for the equities, they were they were always marking to market. So just to set the record straight. Now, why did we have to give that directive?
Some are saying that it kind of disrupted the market. it sold confidence. It brought about a whole lot of things in the market. And
George,
some institutions are down today because of that directive.
George, one of the cardinal principles when it comes to investor protection is that investors must be treated fairly. The SEC recently we were admitted as a signatory, a member of the IOSCO. IOSCO is the International Organization of Securities Commissions worldwide, and is a global standard setter in the security space. Now, one of the key principles is that investors must be treated fairly. Okay, now, why we came up with the mark-to-market directive, which basically we did it to override whatever valuation method the fund managers were hitherto using, was to make sure that there was a fair treatment for all the customers. And let me explain what I mean by that. So you have a situation where you have invested in a collective investment scheme, a fixed income fund for that matter. Now, given what was happening in the macroeconomic space last year, and by that I mean the rise or the surge in inflation and then interest rates, all that was impacting on the valuation of the securities that were in the fixed income portfolio, because the fixed income portfolios basically had bonds. They may have had some other fixed income securities, but principally they had bonds. The bonds trade on the GIFM, the Ghana Fixed Income Market. There's a relationship between the interest rates in the economy and then the bond prices. It's a principle that applies everywhere. And the principle is that when interest rates rise, bond prices dip, and vice versa. So in 2020, given the deterioration in the macroeconomic environment, inflation going up, cedi depreciation also kicking in, interest rates going up, what it meant was that the bonds that were in the fixed income portfolios were trading at low prices or low values. Now, if you don't do mark to market, what will happen is that when an investor wants to check out, wants to redeem, you, the fund manager, will have to sell the security at the market. When you're selling at the market, what price are you going to sell it at? You sell it at the prevailing market price. And because of the surge in interest rates, remember, there's an inverse relationship, so prices have come down. So if you go out to sell the bond, you get a lower value. Okay. Now, if you are not marking to market, you pay the client who is exiting at an elevated value or a value higher than the real value you get when you sell the security. So if you are not marking to market, the investors in the fund who have decided to stay invested in the fund, they will be taking the hit, because you will be going out at an elevated value, because the market value is low. And it's low not because of the fund manager, it's low because of interest rates that have surged. Okay, so without giving the directive of the mark to market, there will be unfairness, because the investors who remain invested in the funds, they will be getting the short end of the stick. Eventually, they could have ended up holding a bag with nothing in the bag. So we had to direct that all fixed income portfolio, they must mark to market. So those who are exiting, because let me tell you what was happening. There were people who were exiting, for instance, to buy treasury bills that were high. So look at it this way. They'll go out at elevated values, and then they'll buy interest rates, they'll buy treasury bills at high interest rates, or they'll buy dollars or whatever it is. Then those who stay in the fund, because more securities will be sold to give those exiting clients, the valuation above the market value. Those of us in the fund will be getting the short end of the stick. So in the spirit of ensuring that all investors are treated fairly, we have to direct, so that both those who are entering and those who are exiting, as well as those who are staying in the fund, It's fair because you are dealing at the prevailing market price. Because I tell people that if I have to sell your security, at what price will I get it? Once it's trading, I have to get a market price. I mean, so I gave this example the other day that, for instance, if you bought dollars, you bought dollars in maybe at the beginning of the year, and at the time you bought it, it was maybe 13 cedis to $1. Okay, today, assuming the rate is 12 cedis to the dollar, if you are going to sell the dollar today, what is going to happen? Are you going to be able to sell it at the 13 cedis you bought it at? No, you sell it at the prevailing price. So the idea of the mark to market was just to make sure that it was fair. So when you are staying in, you are coming in, you are going out, is the fair value, and the fair value is the market.
Remember, you spoke about some funds respecting the rules and it was already happening. What happened to the others who were not compliant? Was it a regulatory lax issue that allowed some of these companies to go ahead and do all these things that this directive was supposed to correct a wrong, ended up bringing a whole disruption to the market?
So allow me to correct, the point you made. So it's not an issue of they were not complying.
Or regulation was failing, maybe some would say.
It's not that. You see, the question is, what is your investment strategy? A manager of a fixed income portfolio can say that my investment strategy is to hold to maturity. I'm not going to be trading my securities. I'll just rely on coupon payments, to meet any liquidity requirement. That can be a strategy. Okay, so it's not an issue of they were not complying. And indeed, if you look at the scheme particulars of most of these collective investment schemes submitted to the SEC, they would have specified the valuation method. Okay, and there's nothing wrong with holding to maturity in essence. Okay, but we are saying that the mark-to-market valuation approach or methodology, it ensures that the investors have, if you like, that equal or fair treatment, whether they are exiting or they are entering or they are staying. Okay, so, but we had to come in because of the fact that we had a situation which we hadn't, if you like, quite experienced in the country, especially since the Ghana fixed income market, started operating, where interest rates had gone up so high that the bond prices were low. And what complicated the issue was that a lot of people were exiting the fund either to buy dollars. I understand that some of them had projects and they felt that given how prices were moving, they needed to get their money out. So the funds, they didn't have the liquidity to meet the redemption request. So in that case, then the option will be to go to the market, to sell. Now, if you go to the market to sell, you're going to get the market value, which is depressed. So without that intervention, there would have been a problem because those who stayed in the fund would be getting the short end of the stick. So it's not a question of they were going against regulations. It's a question of what was their strategy, what was the valuation methodology that they had, basically advertised to their investors that we're going to use this valuation methodology. And remember, it's a valuation methodology. It doesn't mean that it affects the, as it were, the investment that you have made. It's how you are valuing it. And we had to do it because we had a situation where the fund managers had to be selling securities, and if they were not marking to market, they would end up selling all the securities and they would be having investors and there would be no securities backing the investment of those investors in their fund. So we had to do it. So it's not a question of they were a regulatory lapse or they were going against some guidelines. The point is they had a certain valuation methodology that they had adopted, which is part of is accepted. You can say that you hold to maturity, especially if you have a situation where you don't have a wide investment universe to deal with. You typically would just buy and hold and just collect your coupon. So it's not a question of they were breaking some some rules. Even though I know some may argue that when it comes to collective investment schemes, given the fact that there's especially open-ended, given the fact that there's constant exit entry, it's best to use the mark-to-market valuation methodology. But somebody may have an investment strategy. We say that, look, I'll hold to maturity, I'll make this provision for liquidity, and so I would rather hold to maturity because my clients, for instance, they may not like the volatility associated with marking the portfolio to the market. So there may be
different argument.
Yes. I'm just saying that we had to step in to ensure that there was that fair treatment for all investors.
This is PM Express Business Edition. I'll be coming back, Reverend, to get from you as in looking at what has happened right now. Did you thought or think that the approach in this directive could have been done in another way, because some of the players have been badly affected? And also the biggest elephant in the room, the domestic debt exchange program, what is brought to this market. Some are saying maybe the shocks might linger on for quite a long time. Right back after this break. Welcome back to PM Express Business Edition. And we're getting to that point where I know a lot of people will still be asking a lot of questions when it comes to the domestic debt exchange program and its impact on this younger market that was getting there, and several things are happening. Now, Reverend, I wanted to get some clarity from you in terms of the justification for this action. Do you think that looking at the effect now, maybe it could have been done in a different way, that this mark-to-market thing, or it has rather exposed the weakness of the market, some would say?
So I would say that, number one, we did a lot of market engagement, so it wasn't something that, if you like, we sprang on the market. We actually engaged them. One of the things that we do as a regulator, before we come up with guidelines, etc., we usually would engage the market and get their buy-in or debate the issue, get their perspective, get them to understand why we want to do this and all of that. So we had a series of meetings on this particular mark-to-market issue. Of course, there were some who had different views, especially on the timing. Some thought the timing could have been better. Others thought otherwise. Do you
think the timing thing is an issue? Is the issue?
So interestingly, with the domestic debt exchange that you have been mentioning, it came after our directive. And you find that the impact of the domestic debt exchange program in terms of the valuation of the assets on our sector is not as steep as it would have been if they hadn't already implemented the mark-to-market, because I believe if you engage, especially the auditing firm, will tell you that with what has happened, there's a certain way which you need to value the assets in your portfolio. I believe that the time we did it was the right time. I know people would disagree with me, but that's fine. The important thing is that it had to be done. Sometimes you keep, kicking the can down the road, and things might just get worse. So I believe it was the right time, and we did extensive market engagement. I mean, I can tell you that we even engaged some of the stakeholders in the ecosystem, some of the auditing firms. So it wasn't as if we just one day after having a good night's sleep, yes, and then we just issued no
cappuccino in the morning and said, let's go out and do this.
No, we did engagement.
Let's look at the domestic debt exchange program and per the engagement that you've had with government and all those things. What is the communication? Has it really come to an end with respect to the domestic debt exchange program?
Well, on the domestic debt exchange program, let me start by saying that we as a securities industry, we are aware that the macroeconomic environment does impact on the industry. So any measure that would help to, as it were, restore macroeconomic stability is very much welcome. Indeed, a lot of the challenges we experienced last year, you can link it to the macroeconomic environment. So to the extent that the domestic debt exchange program would help the country to get the IMF program, which ultimately would improve, if you like, confidence in the economy or give people a better sense of predictability as what will happen in the economy and, as it were, restore a semblance of macroeconomic stability. I think we welcome it. Clearly, it has had some negative impact.
And that's what I was coming that they compare macro stability to millions wiped off in a day. That is quite interesting. That at one breath, we celebrate macroeconomic stability, but at that individual level, who has got no shock absorbers, who cannot go to IMF to borrow, has had his entire investment wiped off based on this action.
You see, when it comes to investment, especially in fixed income instruments, the issuer is always important. If I say the issuer, the one issuing the instruments, okay. I think the challenge is the fact that for many people, government of Ghana securities represented a safe or relatively safe, asset. So when people are thinking or talking about flight to safety, they will typically first think about government of Ghana instrument.
As a regulator, do you still hold that view, that perception that?
So I'm developing the point. So I think that led to a situation where people, as it were, put all their investments in that particular asset class, and that is what we term as concentration risk. Because what happens is that if you don't diversify and the issuer runs into some challenges, then it puts you in a very difficult situation. And I think for me, one of the key lessons from the domestic debt exchange program is the need for us to revisit the principles of investing, and I said the other day to some people that no matter how good the returns are, you still must respect the principle of diversification, because if you put all your eggs in one basket and there's a false move, you lose everything. Okay, so I think we need to revisit the issue of how we invest and how we ensure that we avoid concentration risk. What is really happening with this domestic debt issue is that the issuer, in this case the government, had issues. If, let's say, it was a company that had issued a bond and it also had issues, I mean, you would also have, and you had invested in the bond. So the point really is, when you are investing, you need to understand who the issuer is, especially if it's a debt instrument like a bond. You need to understand who the issuer is. You need to understand the risks that you are exposing yourself to. Of course, if it's a government, the risk is supposed to be lower than if it's another corporate entity, because of the fact that the government is a sovereign, okay? But that doesn't mean that there's no risk. In fact, we do say that when it comes to investing, there's always an element of risk. It's a question of what is the degree. And so you must always ask yourself, do I have the appetite for the risk? How much risk can I take? And in investing, what other measures have I put in place? So for instance, we tell people that when you're investing, you must have a plan where you have some emergency funds which you can access easily for liquidity needs. So that, for instance, if you have adequate, and actually the experts recommend that your emergency fund should be equal to 6 months of your monthly income. So the income you live on in a month times 6 should be in your emergency fund. This domestic debt thing started when? In November, right? I mean, the actual announcement, November till now is how many months? About, is it 4 to, we're in March. So let's say 5 months.
5 months.
Okay. So if you had 6 months of, funds, to take care of you find that even though there's this development, you will not be adversely affected. But where you don't have any provision like that, then it becomes very difficult. And I know there are people who have been caught in a very difficult situation. I mean, and I think that we need to respect that. But I'm just saying that if we are talking about lessons from the domestic debt exchange program, it means that we need to take another look at how we go about investing. And if I might add, for our market operators, they also need to revise their notes when they are selling or when they are giving investment advice to potential clients, to make sure that they take into consideration all the various parameters.
I asked the question about what is your classification or your position as a market regulator right now when it comes to government bonds, because if you look at the other players, market regulators and all the rest, there are certain laws that restrict investment into government bonds and all those things. Now, your new position on government bonds would influence how these classifications are done. So that's why I'm asking that going forward, is the market regulator going to review its stance or classification of government papers now that it seems to be very risky?
No. I mean, we don't have, as it were, any classification or rating of government bonds.
But should that change now?
We have come up with credit rating guidelines where there should be a third party who professionally, of course, will license the credit rating agency, but who will professionally issue views on the issuers. So if it's the government, and why did Ghana have a difficulty accessing the international capital market? Because the rating agencies had given us a certain downgrade. So I'm saying that as a regulator, what we are doing is we have the credit rating guidelines that would have rating agencies that would rate various,
including government bonds
issuances. Now, when it comes to government security, remember that government doesn't have to come to the SEC when it's going to issue a security. That, I think we need to be clear. It's outside the powers of the SEC. So the government can go to market and do that. But I would recommend that once we have credit rating, the domestic credit rating agencies up and running, would-be investors should take a cue from whatever rating these agencies would give to the issuer, whether the issuer is a government or a corporate entity. The key thing is you need a professional or a third party to give you a view that this issuer has this challenge, or this issuer is likely to meet its obligations under the contract of the debt instrument. So really, the SEC, we don't recommend that go here. Now, when it comes in the collective investment scheme, the LI 1695 would have some restrictions or some areas that you can't get into. But generally, when it comes to investing, it's really about the appetite, the risk tolerance of the asset owner. So if you have the assets, the regulator will not restrict you because you have a certain appetite. What the regulator would do will be to make sure that the market operator gives you adequate information, helps you to understand the risk-return characteristics, and helps you to make an informed decision. We, the regulator, won't make decisions for
I asked you
the investors.
Earlier on about what is the engagement with government on this domestic debt and whether it has come to an end or there are still things being worked out.
Well, as far as I understand, the domestic debt exchange program has been concluded, as far as I understand. I am aware, and I think it's already in the public domain, that I think for the pension funds that were excluded, there was indication that some engagements will be had with them, further down the line. I don't have information on that, so I can't speak to that. I'm also aware that the focus now, and again, it's also in the media, is dealing with the external, holders of the government security. So I would say that giving the information that has been made available from the domestic debt exchange, because I'm aware that, for instance, if you take the securities industry, quite a good number of our operators participated, the same with insurance and so on and so forth, the bank and so I think that we can't say that the domestic debt exchange program that was launched has been successful or has achieved the target they set to achieve based on the information that is available. So if the external engagement also goes well, and I think we get the IMF program, I think that is what really we are looking forward to, so that there can be a better sense of predictability. It can signal some confidence in the economy, and so that we can really build on the economy. I tell people that Ghana still represents a great investment option. I know people may have different views, but if I look at the fact that
some would say debatable.
Yes, but if I look at the fact that you have all these, world, powers, looking at Ghana, looking to come in. You see the interest of China, you see the interest of US, you see the interest of other. It means that we have something here. And so I think we need to look at how can we leverage on, for instance, if I take my space, how can we leverage on the capital market or the securities industry, to unlock capital that we can use to really develop our economy. I think we have something going here. I don't think we should give up. I don't think we should be disillusioned. Challenges are there, but challenges are there to be, if you like, surmounted or to be resolved. So let's look at things from that angle of, how can we make things work? What are the changes that we need to do? I mean, as a regulator, post or after the financial sector cleanup, there are a number of things we have done just to ensure that we are tightening things, we are closing gaps. For instance, I can talk about conduct of business guidelines that we issued that addresses corporate governance issues. And corporate governance was one of the weak links that, if you like, led to the challenges we had in the asset management industry. We have issued investment guidelines that introduces, some strong, restrictions on, for instance, related party transactions, which was, again, part of the challenges that we saw, because people were just, they set up companies and, they were just trading with themselves, So we have done that. We have tightened the licensing guidelines, because licensing is one of the ways in which you can protect the industry and the investors, because that is the entry point. If you prevent people who are not fit and proper from coming in, at least you create a certain environment for the sector, to thrive. So my point is, let's focus on what we can do to make things work better for our...
Are you that optimistic that getting a fund program would help in bringing back market confidence?
I believe so. I think if we look at what happened from when the staff level agreement was achieved, I think we saw some calm of sorts, you know, returning. And I think for many people, I think many years ago, one of the lessons I learned, you know, even about inflation is that even some amount of inflation is not bad. Just that when it is too volatile,
when it's galloping like Zimbabwe's
then it's a problem. What people want is a certain sense of predictability, where you can say that, okay, giving the indicators, maybe the cedi will depreciate by so much, inflation will go so much, and you know that it will be within that framework. Okay, so that sense of predictability allows people to plan, make projections, you know. So if you have some inflation, it may not be as bad as if it's just too much volatility, you know. So I think if we get the IMF program and there's that restoration of a sense of calmness, a sense of you know, predictability as to what will be happening in the economy, it will help. I mean, the problems we had last year, which precipitated us stepping with the mark-to-market, was because people were not sure what was going to happen. So people were just exiting, you know, in droves from the funds, putting pressure on the funds, having to get them to sell securities at depressed values. And, you know, so I think if we have a certain sense of calmness, it can work. We just need to do this, get this right. I think that, you know, things will work.
In your regulation, where do we place the government in terms of as a player or what? Because there are some who argue that when it even comes to the domestic debt exchange program, government doesn't give market information to tell these bondholders who didn't participate in the program, payment schedules. There isn't any strict schedule out there. How is the regulator ensuring that government sticks by the rules of engagement if they come under your perspective?
You see, I think what we must all be clear about is if I don't have the mandate to regulate you, because you are, I mean, by my enabling, because I derive my powers from my enabling act. My enabling act will tell me what I can do and what I cannot do. Okay, so if it's anyone who comes to the SEC to get approval before they go to the market to raise debt or equity, there are some things that we can do. But the law is clear that the government does not need to come to the SEC and is going to raise issues. So whatever the SEC can do, exactly. It can be more.
Are you using the moral suasion?
We do engagements, you know, and I think that people,
when it comes to government,
absolutely. When this domestic debt exchange program,
government is your boss, so you don't try to correct it when it has to be corrected.
No, you see, you have to understand that if I, for instance, all I can do is to give you advice, and if you look in our act, it's very clear that one of the functions of the SEC is to advise the government. I can give you advice. Whether you take the advice or not is a different matter. And I don't need to go say, I gave you advice, I gave you advice. But, and I think that's what people need to understand, that if my enabling act doesn't give me the power to regulate you, there will be a limit to what I can do. But within the broad context of ensuring, you know, the protection of investors and the protection of the integrity of the market, you can do some things outside public view, where you bring the facts and the figures. You show people that, look, based on this is what will happen. So instead of doing this, do it this way, do it that way. And I think people need to be clear that, and it's not everything. The other day I was saying, there's not everything that the regulator does that we necessarily would, as it were, publicize that we've done this. You know, but we are sticking with our mandate to ensure that we protect investors and then the integrity of the market. So there are things that we do, if you like, in camera or in meetings
that you don't want to talk about it in public.
No, and it's not. You see, there are some things that happen that I mean, for instance, I talked about the bailouts that we arranged. But it had to, be at the back. I mean, we had to do some, background, meetings, engagements, before we could even announce it. In this case, because of the nature, it was evident. So I'm saying that we have to work with our act. What you can do, you do it. Now, what is outside of your power? And like I said, the act says we can advise, and when you advise, you give the advice in certain quarters, and it may be fully taken, it may be partially taken, and so on and so forth. And I can tell you that we were engaged in a process, so we give feedback that, look, if you do this, it will impact, let me give an example. For instance, the domestic debt exchange program has impacted, for instance, on the trading on the GIFM. That has implications, for instance, for the brokers, because if you can't trade because the market is virtually at some kind of a standstill from the time it was announced. I think it's now that it's picking up maybe from last month. But so for about 2 months, 3 months, if you were getting your commission as a broker from trades on the GIFM, it means that you are in a tight spot. If you take the Ghana Stock Exchange, they also make their revenue from it. Even the SEC, we get, So, in our engagements, we would bring out all the, if you like, the ramifications of this or that or that. And I think people need to understand that, it's not everything that would come out in the public domain.
You talked about an investor protection fund the other time. I mean,
yes.
the economists would say, all other things being equal, where are we right now? In the banking space, it's been refined, it's up and all there is. For the investing space, where are we right now with respect to this thing that you spoke about the other time?
Great. So let me again say that we have the Fidelity Fund, just that the Fidelity Fund is limited to the stock market, so for activities in the stock market. So what we are lacking is a broader based investment fund, and that's why we are talking about the investor protection fund, which the idea would be to provide some minimum protection for investors. And I'm stressing minimum because in fact there's nowhere that, as far as I'm aware, so maybe
not even in US, and I know,
where investment funds fully indemnify, investors. The idea is to provide some minimum protection. Now we are aware that we don't have, apart from the Fidelity Fund, which is limited and it defined in the
on the Ghana
Stock Exchange. We don't have anything for the asset management industry. So that's why we are now looking at creating the investor protection fund. So about 3-4 years back, we developed the concept paper, for it, but we need some assistance to structure it, because if you are going to attract funds into the fund from various entities, it has to be done in a certain way. So we are having to rely on the services of a consultant to help us properly structure it and then to mobilize the fund. So we are at the stage in terms of doing that background work, to set it up and then to look at how to attract funds into it. So I want to believe that by the end of this year we should have completed the process of having it set up, and then we can look at how it will be funded in a way that it will serve the purpose. But talking about investor protection fund, while it is good, let me quickly chip in that we need to be careful about how we design it. And I'm saying this because if we don't design it properly, it can also have, as they say, the unintended consequence of people not being disciplined in their investment, or people being, excuse me to say, reckless because they have the notion that there is some big brother somewhere that will bail me out. So you need to achieve a fine balance of designing the investor protection fund in such a way to elicit some confidence in investors without the moral hazard of people, not making investments in line with their risk tolerance.
So some will say all other things being equal, maybe from next year, this fund should take off?
Looking
at the work that you've done so far.
I am confident that from next year we should, because we need to have it in place
now.
Yes.
Some would say this debt exchange program has had a lot of shocks for the market, and it's affected confidence. People even I wouldn't pass a day wouldn't pass with somebody asking me, George, where should I place my funds? I mean, some are talking about wanting to buy FX and all the rest. Some have argued that in trying to restore confidence, one major thing is to ensure that the principles of this debt exchange program is respected, government is being committed, all the funds that are having problems, these investors are paid back, and that could be a major turning point for restoring market confidence. What do you say about that?
I agree that it's important for the issuer, in this case for the government, to keep up to its obligations under the new terms of the program, and I think that that fact is not lost on the fine gentlemen at the ministry. So I think that definitely must happen. But I think, all of us, or all stakeholders, and here I'm talking about those in the, especially the financial sector, we need to, ensure that the engagement is sustained, if you like, to demystify, certain myths that people may have, to clarify things, to get people to get a better understanding of how these, the financial products, how it works, especially in my space. Also, to bring out the whole culture of investing, how to go about it, and the basic tenets that you must, be aware of when it comes to investing. I think we all just need to keep at it, ensuring that we are educating people, and we are doing all that can be done to as it were, bolster investor confidence. So I think it's an all hands on deck approach. But I totally agree that the issuer, in this case, the government, must do everything to ensure that they keep faith with the terms under the various debt instruments issued, and I think that would help.
Dr. Reverend, as we wrap up, for you, what else practically is being also done to fast track, and just like what the GFA is talking about, as in bringing back the love, what practically is the market regulator doing to reach out to larger number than thought, to restore that first love where pensioners were all running to these securities? Everybody, even people in SSS, were all doing that. What are some of the practical things you're doing as you wrap up to bring back the first love?
I would say one of the key things that we have seen bothering people is the issue of liquidity, that is being able to access their funds. Now, the domestic debt exchange did impact on liquidity because, for instance, the market, that's a GIFM, almost was non-existent. If I say it was non-existent, it was because people were uncertain as to what would happen. So there was no trading activity, and that put a serious strain on liquidity. So I'm aware that there are a number of investors who are trying to access their money, for instance, for school fees, or very, very
medical issues,
so
devastating.
So absolutely, and it's quite distressing when you hear some of the the stories is quite distressing. So I think the liquidity issue is key. We have been working with the government, with the ministry, on how we can address the liquidity issue. But hopefully, once the GIFM picks up and starts trading, it would help to address. And I'm happy that as we've seen a downward trend in the interest rates on the government treasury bill, that if you ask me, is a very positive development, and it should help in restoring trading activity, and therefore the liquidity on the market. Because liquidity is one of the key things that people look for, and it gives them confidence. They will tell you, even if I'm not getting anything on my money, just give me my money. You know, so liquidity is one of the key things that you know, we are working on. As you may have heard, when the domestic debt exchange program was announced, there is the Financial Stability Fund that is supposed to also be an avenue to provide liquidity when all else fails. So the mechanics of that is still work in progress. I think some progress has been made, and you know, so basically, addressing the liquidity thing is key, and we are making some progress in that area. But I think we still need to do the investor education bit. We, as the SEC, apart from the time with the SEC program that we launched, we have put together. And maybe let me quickly add that under the Capital Market Master Plan, one of the working groups, working group 2 to be specific, handles increasing the investor base. And investor education is one of the key deliverables for that particular working group. So working together with our communications team, we are looking at how to use various or multiple channels to reach people, just to calm people, to get people to understand. I can tell you, someone called me quite agitated. Hey, I don't understand this DDE thing. I'm going for my money. And I just took my time and I explained. And she said, oh, really? You know, so there's a lot we can do to get the message out there, you know, so that people get more comfortable. A lot of people are relying on rumors and things that people are saying, which is really confusing.
And that all means that you have to maybe up your game in terms of the SEC to do more to quell some of these rumors out there, Reverend.
I don't disagree, but let me also, you know, task you, the media, to also make sure that you put out the information, wholesome information, if you permit me to use that, because I've had concerns in the past where we've had, you know, some reportage which, excuse me to say, maybe was a bit sensational or may have triggered more fear and panic than, you know, education. Well, so we all have a role to play. We'll step up our
such opportunities is helping to deal with the challenges. I appreciate your time, Reverend, and I know there are still 1,001 questions out there that this program might not be able to answer, but we've gone a long way to deal with some of the concerns for the market, and hoping that it would help bring back the confidence that we are all looking for. This is PM Express Business Edition. I know the debate is going on in your offices and homes. What else can be done, or can it be done in another way in helping to restore market confidence? My name is George Wiafe. Have a great day.